The world has changed, leading many to question the future of the economy and their personal finances. Burden understands the changing dynamics of the market and the economic realities facing our communities. No one can predict the future, but having an advisor that maximizes your tax advantages and helps achieve your financial goals can lead to greater stability. Let Burden's accountants and advisors help protect you, your family, and your business. Burden LLP. We listen, we solve, we do.
Well, good morning, everybody. Very happy Friday to you all, and thank you so much for joining us today. My name is Kathy Cunningham. I'm the co-deputy editor and also finance editor for the Commercial Observer. And it's my extreme pleasure today to be joined by a panel of highly esteemed experts in the market to talk about the state of the multifamily housing market. Today, I'm joined by John Cannon, president of CPC Mortgage Company, Myron Mintz, tax partner at Burden LLP, Martin Nussbaum, principal at Slate Property Group, and Sebastian Post, co-head of investments at Lionheart Strategic Management. Good morning, everybody.
Morning.
Morning. Morning.
How are you all doing today?
Doing fine.
Ready for the weekend?
Yes, I am, yeah.
Yeah.
I definitely know that feeling. Before we get started, I want to thank our sponsor today, Burden LLP. And I also want to open, for the audience that's watching today, and we want to make this as interactive as possible. So if you have any questions for our panelists, please do submit them via the Q&A function at the bottom of your screen. We'll get to as many as possible, but please do feel free. Like I said, we have a great panel of experts here ready to take your questions. So as I said, the title of this panel is A State of the Multifamily Housing Market. So as a kind of a starting point, I'd love you all to kind of weigh in on your perspective on the multifamily market today, what you're seeing, the health of it, and any particular observations you might have. And maybe as you do that, maybe also give our audience a general overview of your firm and your role in the firm. John, do you want to kick us off?
Sure. Good morning, everybody. My name is John Cannon. I'm president of CPC Mortgage Company. It's around a 50-year-old not-for-profit based in New York City. We do a lot of construction lending, some equity investments, and mortgage banking. So we do Freddie, Fannie, and HUD, not only in New York City, but nationwide as well.
And John, what are you seeing in the market today? Anything that strikes you as we go into?
Yeah, I mean, it's almost the best of times. It's
right.
Not the good to great. New York City and its surrounding areas is pretty good health-wise. The Sun Belt markets are doing absolutely fantastic, particularly, Class A suburban Sun Belt markets are just as good as it's ever been. So yeah, it's all pretty good.
Certainly seems to be definitely a wave of optimism out there that's just been going for a long time and continues to keep going, right?
Yes.
Martin, do you want to take it next?
Sure. Martin Nussbaum. I'm a founder and principal of Slate Property Group. We are a owner-operator in the New York metropolitan area with some exposure also in a satellite office in California. So we are obviously heavily based off on the multifamily side of the business. I can speak a little bit more directly about the New York metropolitan area in California a little bit less so about all the enthusiasm and euphoria in the Sun Belt area. But the New York area has recovered. I think it's really stabilized in a very significant way. And we're starting to see some really interesting growth and opportunity right now that we're excited about. Having lived through a solid 18-month sort of downturn, I think we are starting to see the base. We've started to see some growth, and we're pretty excited about what's coming in the next, in the next cycle.
Excellent. Sebastian?
Hey, thanks, Kathy. So Sebastian Post, Manager Director and Co-Head of Investments at Lionheart Strategic, which is the investment management arm of Fisher Brothers that manages money not just for the family, but as well as investors as well. Obviously, Fisher Brothers is very New York focused, Washington, D.C. focused, and that's where our core holdings are. But Lionheart, through the credit space, has been active kind of around the country. It's kind of crazy to see New York where it was 12 months ago.
Right.
I still remember giving out, 5-6 months concessions on 2-year leases. But now that's kind of virtually gone. So I feel like New York's, at least in the multifamily sector, coming back really strong. And the Sun Belt hasn't been a better time. So I think due to all the migration travel from some of the New Yorks and Californias of the world, those markets have obviously done really well as people have relocated the last 12, 24 months.
Right, absolutely. It's interesting. We'll get to markets later in the conversation, but I feel like, it's very hard to get it. Well, what I hear is very hard to get an apartment just now in New York City. The time where you can get one easily and, multiple concessions and what have you is kind of over now, right? So it's probably a good sign for the market. And Meyer, how about you? What are you hearing from your clients today?
Yeah, Mayor Mintz, I'm a tax partner and co-chair of the real estate group. It's interesting, like everyone else we're seeing, everyone was very nervous at the beginning when people were leaving. Based on the survey that we did, there was a significant amount of vacancies in these buildings, and now they can't find people to fill it up. A lot of people are concerned with turnover because as the tenants that did get these big concessions do roll their leases and start seeing $600-700 increases in their monthly rent, a lot of people are concerned that they may have some hesitation to renew at those rates. But we've seen a shift from finding tenants to controlling costs. I mean, with today's costs spiraling the way they are, the question is, could you increase rents as quickly as the inflation is in order to recapture some of that? So we're seeing a lot of stuff on that. We have been advising a lot of clients on some transactionals where they're buying pretty significant portfolios in places where I've never seen people look before to try and figure out which markets are coming next, which has been very interesting for us.
And can you give us any kind of insight into the markets you're looking at just now? Is the most appealing, or?
I've seen more activity in Michigan than I've seen in the past. I've seen activity in just, big cities throughout the U.S. that are not the gateway cities, because a lot of the gateway cities are already overpriced or, priced fairly, I guess. And people who are bargain hunting are buying volume outside of a lot of these cities, outside of like the Nashvilles, Atlantas, Floridas, Californias, Texas.
Yeah. Interesting stuff. Now, we as a publication, throughout the pandemic, we've heard about really two kind of darlings of the real estate world, which are multifamily and industrial. So do you feel just now that multifamily is hanging on to that crown in terms of being the asset class that people are gravitating towards, either from a lending or investing perspective? And if so, why do you think it's fared so well during the past 20 months? John, do you want to take that?
You said, why is multifamily faring so well?
Yeah, why is it fared so well during the pandemic? Why is it so resilient?
It's people need a place to live,
right.
And in industrials, just benefiting from just the dynamics of the retail market and the Amazons of the world, and people need places to store their goods in between, factories and delivery to their homes. But multifamily has always been a relatively low beta, asset class. I mean, it's a sort of steady Eddie, and it's just looking fantastic now, simply because all the other asset classes are doing terrible. I mean, offices, I don't want to get into that. This is a multifamily panel, but office has its unique issues given work from home and some of the dynamics about urban outflight. But multifamily, you need a place to stay, to live, and it's performed quite well.
Right. Any big surprises during the pandemic in terms of how well it has fared? Like you said, obviously, investors have allocated capital away from office, retail, hospitality, and are focused more on multifamily today. But any big surprises for you, John?
The big surprise for me during COVID has been the relative weakness in the Brooklyn market in particular, and it's sort of subsided and has come back, generally speaking, but there's still some leftover cautiousness in the lending community, Freddie, Fannie in particular, with Brooklyn markets. And, I don't think owners were used to giving away free rent and chasing after tenants. And that was, that's something that happens all the time in like a market like Texas, where there's a lot of new supply. And I just think Brooklyn owners were taken by surprise by COVID, as we all were. But I think that market surprised me in terms of how impacted it was in this over the last 18 months.
And Martin, do you want to add anything there? I know that, obviously Slate is very active in the outer boroughs, and also so is Scale Lending, your lending platform. So any take on the boroughs and how they fared?
Yeah, I mean, I think I just want to go back to what something John said. I mean, I'm actually equally surprised at how aggressive capital has gone outside of the major urban markets and been willing to sort of chase after some significantly lower yield that we haven't seen in many of those submarkets ever in history. So I think it's really interesting to see what has happened and how quickly that money has moved from some of the major cities into some of the more suburban markets. I think that's really interesting, and I'm curious to see how that plays itself out over the long run, not the short run. It's a little bit of a herd mentality of like, all of a sudden everyone took all their money and said major urban cities are done, and let's go plow money into some of the suburban markets. And I appreciate the A locations, but some of the I'm hearing deals that are happening in tertiary locations that are sub 4 caps that are very surprising. But specific to New York, I mean, I think New York definitely for the first time in my career, my 20 plus year career, saw some challenging times that I had never seen, even sort of post 9/11 or post 2008 9 crash of the market. It was very different. Here it was almost it was something that took a solid 9 months to sort of stabilize before anyone have had their footing underneath them. And it's been very surprising to me at sort of how quickly it all recovered. I think specific to Brooklyn, on the lending side of our business, we've gotten very aggressive. I personally think that the housing supply is very limited in the Brooklyn and obviously Manhattan and all the boroughs market, and particularly with the looming new affordable 421A abatement program expiring. I think the ability to bring new rental product to the market is going to be stalled. So I think there's going to be a pretty significant recovery, and we're already seeing it. Month over month, the improvements have been very tangible. So I'm not sure why other lenders went a different direction, but we, on our lending side, actually leaned in very heavily into the New York metropolitan area and have been very, very active in it.
And so, Martha, did you find good opportunities as some, lenders and investors looked outside of New York City to more suburban markets and secondary, tertiary markets? Did you find good market opportunities because of that trend earlier in the pandemic?
Yeah, I mean, frankly, I think early in the pandemic, I don't think anyone did anything. I think we all paused and we took a little bit of time to figure out, what the pandemic really was, both like from a health perspective, a family perspective, and then ultimately you reverted back to your normal life and said, okay, like this isn't the end of the world, and what do we do about it? So I think once that was understood, we felt a lot more comfortable in the debt space to start. So probably from the summer of last year until probably the beginning of this year, it was very focused on the debt side. And then I would say starting in March of this year, we started to feel a lot more comfortable to take equity positions and take longer perspective on the equity markets recovering. So I do think we found some really unique opportunities, sort of getting back into the debt space quickly. And I think we were a little bit ahead of the market, which is catching up to us quickly on the equity side.
Right, absolutely. Then Sebastian, recently Lionheart made news because you made a mezzanine loan on 550 10th Avenue, but more broadly speaking, throughout the pandemic, how have you viewed New York and lending opportunities on the multifamily side?
We were a little cautious at first. We spent more time outside of New York, just given what our portfolios were doing within the New York City and DC. But we became very bullish kind of, 6 months into the pandemic, trying to do as many multifamily deals as possible, knowing that the world's going to eventually get back to normal. And since we're all doing construction loans, it comes back to normal for us in 3 to 4 years. That's all that really matters for us, right? If it's not good in 4 years, I think we'll have much more difficult problems to deal with. So we're very bullish, and we're also specifically in New York and on the credit space, and especially with 420 expiring. I think we don't know if that's going to get extended, and if it does, and what it's going to look like. We do see that being a cap on supply, at least for the short term. So there's going to probably be a period of time where there's not a lot of new projects being delivered in 23 and 24, where we think whatever gets delivered is going to be able to command a pretty significant price premium.
Right, absolutely. And Sebastian, for any of our viewers that perhaps don't know Lionheart too well, so you're frequently in the mezzanine position in the capital stack. So why do you like the mezz spot? Why is that a good place for you to play?
Mostly because we can make more money.
Yeah.
So our target returns are 10 to 14. If I had cheaper capital and people were willing to give that to us, we would do senior loans. But we do senior bridge loans. It's just our cost of capital. I have to deliver investors a reason to invest with us, as opposed to being a bank and lending at 2-3%. So that's our, and we like the mezzanine space, especially on the construction, because that's our bread and butter on the Fisher Brothers side. So we have a services relationship with Fisher to monitor all our transactions. So
Sebastian, to your point, I mean, it's a great opportunity to get a 10 or 14% yield on mezz when equity is getting a 4% cap on an unlevered basis. That's unusual where debt outperforms equity returns.
Right.
Yep.
Absolutely. And then John, so you joined CPC November 2019, so just before the world kind of fell apart. So how was that experience for you, joining a new firm and kind of taking the reins as president during the pandemic?
It was interesting. I mean, I used to work at Freddie Mac and ran nationwide production for the multifamily group at Freddie Mac for 8 years prior to joining CPC. So CPC is very focused and steeped into the New York City market, New York State market. And what we tried to do with the mortgage company is broaden our horizons a little bit by expanding into other markets. And I think that ended up being pretty good. If I could go back to a discussion a little earlier, which is, the health of the New York City market. I think if you are, equity, everybody, the Sun Belt markets are the shiny penny. That's where everything's going. I do think debt is very attractive to invest in the New York City markets right now, because I do think it's a low point in equity as well. So I don't want to give the perception that I'm down on New York City in any way, shape, or form. I just think if you look over the last 6 months, it's relatively underperformed, but I do think it's going to reverse itself on a go-forward basis. The mortgage company is, we react a lot to Freddie and Fannie and HUD, right? So that's, so it's by and large their credit decisions and their pricing that drives the flow of capital. So it just so happens that Freddie and Fannie, got burnt a little bit in certain markets, at the beginning of COVID. And I think it's generally recovered. And now with Freddie and Fannie having their volume cap issues resolved, I think it's full speed ahead.
Right, absolutely. And which markets are occupying the majority or taking up the majority of your origination efforts today, John? Are you find yourself lending predominantly in the tri-state region?
It's generally speaking 50% in New York City, New York State, but some significantly larger deals in outside that market. So just closed a $70 million deal in Texas and a $57 million deal in Kansas City, and CPC tends not to do those size transactions in New York City and New York State.
Right, got it. Now, Mayor, Commercial Observer and Burden, they recently did a survey. I think it was 500 people on the multifamily side to basically look at the state of the multifamily market and what they're interested in for 2022. So, do you want to maybe recap some of the key findings from that survey and that report?
Yeah, I mean, it was very interesting because we're seeing a lot of activity in multifamily and everyone's talking about it. And it seems to me like based on the results of the survey, people are generally holding. No one's really looking to dive in, but no one's really looking to dump, which is very interesting because I think it was 23% of the people said they were looking to sell. You would think in a market like this, where especially this was done kind of a few months ago before a lot of the uptick. We also saw there was relative strength. I mean, everyone was afraid people would stop paying rent if people are not living there, if they're moving out, and if the offices are not there. But most people were collecting 70–80% of the tenants were paying rent. So it looks like, we also did see from our clients a good split between the better landlords that had the tenant relationships during the hard times of, whether it's problems with the plumbing or problems with the building, and they took care of their tenants. The tenants reciprocated and took care of the landlords and didn't stop paying rent. It was more like just the people who collected the checks every month and were hard to deal with. The tenants were a little harder with them. We also saw a flight to quality. People looked at the better buildings and looked for, the larger, shinier buildings with the amenities. A lot of the better landlords did try and amenitize it for the work from home or to give tenants a little more flexibility if they needed it in terms of payment terms and stuff like that. But, the survey was surprisingly strong. I encourage everyone to take a look at it, but, it didn't look like it was as bad as people thought it would be. The biggest issue that a lot of these people having is just cost of goods and getting the goods. Because if you're running a building, you kind of need to have that repetition of the deliveries of whether it's just, the supplies that you need to clean the building, or, if an elevator breaks, you need that part. And people are concerned that with the supply chain and the inflation the way it is, that a lot of those costs, those were the two biggest issues. The third one was just hiring people, especially in New York where the labor market's very tight. It's going to be challenging just to get that low-level person that's in the building every day to kind of maintain it properly.
Sure.
But it was more optimistic than I expected it to be.
And then in terms of, urban versus suburban markets, there's also some feedback there, right, in terms of those trends.
Yeah, the suburban markets were a little better than the urban markets, and I think that's mostly because they are a true community. In Manhattan, you can have 3 buildings right next door to each other. Most people don't know their neighbors. They're kind of just going to work, going to the bars, and hanging out with their friends in different buildings. In the suburban markets, they kind of create a better sense of community, so people don't leave as much and people want to be there more. So you do see people who are paying rent more, who are not leaving as much, so the vacancy rates were a little lower. And there may have been a flight from urban to suburbia during the pandemic, because as the city shut down, people were looking to go to a restaurant. The restaurants were closed, or socialize, and there wasn't as much opportunity, or whether it's outdoor space, because in the city, the outdoor space is really just sitting on the street versus sitting in a nice park somewhere. So there may have been a little of that, but from what I'm being told, even though the downside was a little less in suburbia, it didn't look like the prices went up as much as you would think, given the relative strength during the pandemic.
Right. And I'd love to hear the other panelists' thoughts on this also. So is this, migration from urban to suburban markets or tertiary markets and what have you, is this a lasting trend from COVID, do you think? Or what are you seeing in your individual seats in the market? What does your data tell you?
Kathy, that's the big question. I mean, we had 20 years in the 70s and 80s and early 90s where there was migration away from urban areas to the suburbs, suburban flight, and then 20 years where it was back to the cities. Everybody wanted to live in a city, and the last 18 months have gone back to suburban flight to a certain extent. And I think the jury's still out. Where we land in terms of this remote working or hybrid work environment is really going to tell the story. You get some firms that are saying, listen, I want all my employees back at work 5 days a week. And you have other firms that are saying, hey, listen, you can work wherever you want. I don't care if you work in Salt Lake City or Cleveland, or that you pick it, right? We'll meet virtually every day. And I think that will tell the tale. And the story's not over yet, where we don't know the ending, in my opinion.
Right. Still a lot of questions. It does feel like we're in this kind of period of limbo right now, where there's a lot of, I think maybe the turn of the year might help kind of clarify some of these questions, right? One of the
things I'd like to add is that
sure,
it was very clear that last year and the beginning of this year, there was a flight out of urban markets. But if you look at the urban markets that we are in, they're back to 98, 99% occupied. So those people came from somewhere, right? So there's clearly been a flight back into New York over particularly the last 90 to 120 days, where people are back into the city, not just from a rental perspective, but also, we are condo developers, and we have some loans on some condo projects throughout the New York metropolitan area. And the condo projects have been extremely successful and active over the last 6 months. And again, not necessarily at the same pricing that we've historically seen, but at the appropriate reduced pricing of where the market needed to move. We once again are seeing people put down seeds to live in New York permanently, not just as a renter, in a dramatic fashion. I mean, the condo market has been absorbed dramatically in most residential markets. In the markets that are secondary in cities, they still are challenged, where you are looking for overseas investors or people who just aren't full-time or pied-à-terre investors who aren't really living in New York day to day. But I will tell you that I think a couple of things. I think that the New York market has significantly leased up and has sold out. And there's also been a trend of just a younger person moving back into the city, because the people that have left, in my opinion, 95% of them were probably going to leave in the next 3 to 5 years anyway, because it just wasn't the right place for them to be permanently for whatever reasons. And so I think that what I've seen is that the market's back dramatically in New York, and I'd be curious to see if it doesn't just grow from here, because we haven't really even brought back in international renters and buyers because of COVID at this particular moment.
Really interesting. I think it's definitely a trend that we also noticed, earlier on, that there's this younger demographic that are now moving into New York City and other markets like that because they could afford it earlier in the pandemic. And then it seems to be a new kind of wave of this new blood that's, coming back into to New York City. Whether I think maybe slightly older people that were perhaps residents before in New York are now moving out or have moved out or what have you. So I think it's a really fascinating trend. Sebastian, what are you seeing in that regard?
I was going to say Martin said it perfectly. We see it basically the exact same way. I would say people that were going to leave left, right? So my friends, I'm in my 30s, and all my friends that are now having kids and they're all leaving, they're going to suburbs. They were going to do that eventually. But the young talent goes where there's universities and where there's jobs. And the tech companies believe the jobs are still in the cities. So they're signing massive leases in New York and Nashville and Austin and maybe not San Francisco, but some other markets around the country. So they're trying to find the right talent. And, unemployment's 4.5%, right? So there is a desperate need for high quality employees, and they're in the cities. So I think there's a reason why the cities have outperformed so well the last 20 years. And we have an inherent bias because we only focus on cities.
Yeah.
But there's a reason for why that has worked for the last 20 years.
I think Sebastian makes a really good point. Sorry, makes a really good point. It's like, if you think about it, over the last 5 years, the biggest boom from an office perspective has been technology, which never really existed in New York, right? We've been a very big Wall Street banking city, and the largest office transactions, both on a purchase and a leasing perspective, have been on some of the larger tech companies at Facebook and Google. And so, there's tons of them, and that money has never really been here before. It's been in other locations.
Right. Absolutely.
Martin,
one of the fascinating things. Sorry, John, you can go ahead.
No, I did very quick. I do think banking and finance, I think generally they want their employees back in the office more than perhaps some of the other industries. The only thing I would add, and I agree, Martin and Sebastian, with points about occupancy going up. The other part of the equation is collections. And I do think Class A, Class B, and subsidized housing collections have been very strong and back to where they were pre-COVID levels. It's that workforce housing that is non-subsidized where we're seeing some collections lagging the improvement in occupancy. So that's the tenants that are not receiving any subsidies, the tenants that are generally speaking non-college educated, literally workforce housing, the backbone of the renter community, are still struggling to make their rental payments.
Interesting. And is that across markets, John?
It is.
Sorry, yeah, across markets. Sorry, go ahead, Mayor.
No, I just wanted to point out what's intriguing to me is that, occupancy on the residential side is very high. And you would think if office occupancy is averaging 30 to 35% because no one's showing up, people wouldn't even want to live in the city. But it seems like everyone's coming back, but the offices are not full. So, that's something, I guess, because of the amenities that New York started opening up, whether it's the restaurants, Broadway, and everything else that people can enjoy. That's really what's bringing them back. I'm curious to see when the office opens, if demand is even going to go up higher because of that.
Yeah.
Absolutely. Yeah, our office is downtown on Whitehall Street in Financial District. And, it's like you said, I think New York is back in pretty much every way, but offices are still very, very quiet,
But it's interesting that the multifamily is still fully occupied, even with the less people coming into the office physically.
Exactly.
I think that's a combination also of once the school systems all opened up, and that was a big factor, right? If your kids are not in school, it's a very big differentiator between where you live, right? When my kids weren't in school, it was like, okay, there's a lot of places you could be if your kids don't have to be in school every day. So I think once the school system opened up, I think people had to put themselves in places where they had to be around that school system, whatever it is. And I agree. I think once the office market opens up, and if it's a 3-day a week, 4-day a week, 5-day a week, I think no one on this call is going to know until for a couple of years, but inevitably it's going to be something along those lines. And I can tell you that on the handful of days a week that people are generally in the office, even today, even if it's, 1/3 of the office is open, generally like on a Tuesday and Wednesday when most people are probably coming to the office, the traffic is a disaster. And the people who work in the office for me who are commuting from wherever they're commuting from are not happy about it. And if that turns into a mandatory 3-4 day a week where people are in the office, and even if it's Monday to Wednesday, Monday to Thursday, or whatever that lands up being, and I think there will be some hybrid of that going forward, there's going to be a massive push of people back into the city, and we're already at an occupancy of 97-98%. It's going to be, I mean, we took a beating for a couple of years. I think we're entitled to have a couple of years of recovery. So
absolutely. Couldn't agree more. Now, one thing you mentioned, Martin, was that the flight to quality, and I think that's also a trend we've seen on the office side, right? It's a lot of, tenants on the office side are upgrading to Class A, whatever they can. I think also, residents in multifamily buildings are also looking for a better deal and a better building. So how important is that today in terms of having a Class A, top quality multifamily building to offer the market today? How key is that?
I'll jump in. I mean, I think it's a pricing metrics. I think it's about what people can afford along the chain. And I think over the last 18 months, you were able to go to a better quality building because it was cheaper in any asset class, right? And so I think, sure, would everyone love to live in the best building in the city and work in the best building in the city in the ideal location? Sure, it gets to a point where that gets priced down. Or up, and then the chain starts to get filled beneath it. So I think, no different than the multifamily space, or frankly, we've seen a lot of it in the office space. Everyone sort of went to a better quality building, and that makes a lot of sense. But when those apartments turn over, I think Mayor said it earlier, and all of a sudden your apartment, when it goes up by 50%, you're going to make a decision if you want to pay that 50% or move to the next building down that is within your price range.
Right, absolutely. Sebastian, if you have a take there in terms of, what are you comfortable lending on today? Is it only the Class A kind of assets you're lending on, or would you be comfortable with a Class B multifamily assets?
Yeah, definitely happy to. I think we're trying to look at is kind of where we have capital preservation, right? We just don't want to lose capital because these are all credit investments, and our investors demand a return of capital plus a premium or plus a rate of return. So whether it's brand new Class A or Class B, as long as they kind of think we'll get paid off once the sponsor's complete with their business plan, we're agnostic to it. So.
Right. Absolutely. And your recent investment on 550 10th Avenue, so that's a mix, right, of a market rate apartments plus middle income and what have you. So is that something that Lionheart kind of pursues in terms of, an ideal kind of mix, or does that just happen to be for this particular project, or why was that the mix there?
Well, in New York, you can't really get tax saving without the affordable component to it. But I would say if there's an affordable housing component to a project, we do spend a little bit more time for it. Mostly because our investors like to see ESG related strategies kind of within our portfolio mix. So we do try to make our best effort to finance as many projects that are both environmentally friendly and socially conscious. So it is a focus of our company and kind of our business strategy.
Excellent. Now, ESG is something we've heard a ton about recently. And, we do sometimes you do worry that it's lip service from certain companies, but, I think it's something that the industry as a whole is very focused on right now. So would anybody else like to weigh in on, the importance of ESG in terms of your investments and your activities today? Martin, do you want to go ahead?
Sure. I mean, yeah, so I couldn't agree more with what Sebastian was saying. I think ESG investing has become something that's a lot more relevant in everyone's mind. And frankly, it's become something that's become very institutionally focused. So I think that's another interesting thing to note, that it's not just, it's everyone across the board that's interested in having exposure to it for various different reasons. So we've been in the 100% affordable housing development business for 7-8 years. We've probably developed, north of 3,000 units that is pure 100% affordable affordable living. And over the last 2 years, we've gotten a lot more into transitional housing, which is inclusive of homeless shelters, facilities that help rehab people to bring them back out onto the real world in a healthy manner. And it's something that we feel very strongly about for various different reasons. And One of them is, I think New York is, and a lot of cities around the country are very much in need of facilities and programs that help people not just get off the street, but also rehab and have services around them to help them get healthy, to a place where they can stand on their own. So the ideal situation is you have someone who has needs, or a homeless need, or medical needs, or mental needs, or whatever the situation is. You bring them into a facility where they can live comfortably, safely, as well as provide them services within that facility to rehab them back to a place where they can then graduate into an affordable housing community, and they can stand on their own 2 feet and support themselves in a healthy manner to the point where they move on to the next part of their life. And it's something that we're very focused on. We work with a lot of non-for-profit organizations when we do that, and really focus on having people. It helps clean up and provide safety to the city. And I think importantly helps the people in need get back on their own 2 feet and provide for themselves. And that's the only way, in our opinion, that there's a long-term solution. A long-term solution isn't just housing people and putting them back on the street and, unkept and unwell and not being sort of around services and ways for them to live in a comfortable way.
Right, absolutely. John, how's CPC approaching ESG today?
I was just going to say, whether you agree or disagree with what's happening in ESG right now, and I happen to agree wholeheartedly behind ESG initiatives, that train is coming down the track, and you better be prepared for it. If you are a REIT, you get scored on your ESG initiatives, and if you don't score high enough, firms like Vanguard and Fidelity will not buy your stock, and your stock price will tank. If you are a fund investor and you don't address ESG, you will see those fund investors pull money or not invest in your next fund. If you are an owner, operator, sole proprietor of a multifamily, Freddie and Fannie, which supply 50 to 75% of the debt in this market, they are promoting ESG initiatives, whether through support services for tenants or environmental incentives for green. You got to get on board, and if you intend to sell real estate, you better be addressing social aspects of your tenants and the environmental impact your building has. So I look at it from the perspective, and CPC looks at it from the perspective of, it is mission-based. It's something we need to push, something we intend to push, and we think it's just, again, whether you like it or not, you better deal with it, because whether you're an owner now or whether you intend to sell, it's a reality.
Absolutely. We've seen a big focus on it. And I think there's so much worried about, holding firms accountable and in terms of what they're saying versus what they're actually doing. But I think there's obviously metrics now in place to try and track that and
no
do
question.
that.
Utility usage and a whole variety of factors.
100%. Amir, any thoughts there on ESG?
I mean, we've been seeing a lot of clients focusing on solar. It's starting to pick up a lot, just to try and see if they can put panels on the building to make it more environmentally friendly. Obviously, the new construction has a much bigger focus. In New York, it's very hard to retrofit some of that stuff in, especially in the mid-block buildings that really don't have much to do. It's interesting. We see clients more at the management company level focusing on ESG than I've ever seen before, whether it's inclusiveness, whether it's the programs that they do, like Fisher Brothers did a program with us to a bunch of high school students through the Legal Outreach Organization, where we basically explain to the kids what real estate's all about. We've seen a lot of those types of programs that a lot of the big players just pick up recently, which is great. It's encouraging that a lot of these younger people that may not have had exposure to the real estate industry are getting that exposure. So to me, that's the kind of stuff that I've been seeing more, not at the property level themselves.
Absolutely. We've seen, Project Destin, Cedric Bobo, that the platform he has there, I think, is wonderful and doing so many great things. So
One
we
thing
actually met with them a couple of weeks ago.
On the E part of ESG, I mean, we are seeing just a push away from fossil fuels and more towards electric, just simply because it's easier to create efficiencies by doing something with one electric plant versus, a myriad of individual oil-based systems at the property level. So I do think there's a trend towards electrification and away from, sort of oil and even gas.
I got a good story for you. I was with a broker yesterday who was trying to convince me that second floor apartments in a condo building are worth as much as a higher floor apartment. I said, it's a wonderful idea. And he said, imagine in 10 years from now where every car is electric, there'll be no noise. And that was his big, like, because, and I was like, that's a phenomenal line. I'm going to put that in my materials, right? I mean, but conceptually, in theory, 10 years from now, if we're all driving electric cars, they are very quiet, So he's like, it's,
Yeah, that's like the old law school case where they sold beachfront property in Nevada.
Exactly.
Oh dear. It's great for your offering memorandums and what have you. Now, a question from the audience here. Do you think promoting healthier environments through things like physical air purification devices will positively impact either attraction/retention of tenants, leasing premiums, etc.? Anybody like to weigh in there?
I would defer to Martin and Sebastian. I'll weigh in. Just the amenity packages of apartments, it tends to ebb and flow, and at one point you absolutely need a golf simulator, or you need a doggy concierge, and this you need super air purifiers in your gym to attract tenants. I think there will be some of that in the short term, right? And that will have a positive impact. It's a question of just, is that long lasting? Does that have legs to last, past this COVID period? And will tenants actually pay a little bit more money for better air purification systems?
Yeah, I would say definitely for the office space, right? That's been in the works for years. For the residential space, I don't know if the general consumer knows the difference between the type of air system they have in their apartment. They might pay a premium to have a balcony, because we all were cooped up in our apartments and wanted to have outdoor space, and that's an easy way of doing it. But I don't know if they generally know about, whether a HEPA filter inside their apartment is worth another $100 in rent.
Right.
Yeah.
Martin, any thoughts there?
The answer today, sure. Do I think someone today, if you put on your marketing material and said that you had a air purifier system on your air conditioning system, would they pay for it? I don't know if they'd pay for it. Would it be something they'd be like, oh, that's great, and they check the box? And when you walk into a lobby today and you see one of those like filters, like those air filters when you walk in, and it, in my personal opinion, depending on the size of the lobby, probably does less than 1% of the filtering that you think it does. But in theory, when you walk in and you see it and you breathe freely, I would imagine that someone feels good about it. I agree, though, that I think this is I think it's a trend for the current moment. I think amenity spaces, and this not necessarily is an amenity space concept, but it is an amenity to the building. They change so much. And I think that I hope that COVID's not going to lead us into a place that we all have to worry about filters forever. And I feel pretty strongly that that's not going to be the case. But, to answer the person's question, I think, sure, today, does that help 100%? And it's to Sebastian's point, I think going forward, office buildings is going to be a requirement.
Right. And Martin,
I think also it depends on the mix of the tenants. Like if you're marketing it to a family-oriented tenant mix, they may care a little more. But for the 23-year-old that's sharing a room with 4 other of his friends and just came back from the bar and is just sleeping for 6 hours, I'm not sure the HEPA filter really does anything for them. But if you do have a family-oriented building, sometimes people do look, especially if they have younger kids or kids in school, they want to make sure they have as much as possible.
Sure, that's very good. That's a very good point, Mayor. And then Martin, what is the most common request you're getting today in terms of, tenants signing new leases at your properties, or anything you're particularly looking for, or kind of weighing your property up against others, in comparison with?
Yeah. Look, I think the truth is we are, for the first time in a long time, in a position of a powerful position. I haven't been in that position in a while. So right now there's very limited supply on the market. I think people are very concerned right now, in my opinion, some of our older buildings, and like, is there going to be any renovation? Are you going to be doing any work in our buildings? I think that's a big question that people should be asking, and I think it's a good question. And I think the other question is, how would you deal with your amenity spaces if there was another shutdown? That's another question that I think people ask. Because if you think about a lot of buildings, we've opened up our amenity spaces in our buildings, in various different ways, and you can share, you cannot share. At this point, it's probably predominantly open. But I have friends and I go to visit other people's buildings, and their amenity spaces are still completely shut down, which I think is interesting. I mean, I guess everyone makes their own decisions, or even the condo boards make their own decisions because a lot of these buildings are condos. But I think the big questions are, what's going to happen with your amenity spaces? Am I going to be able to use them? Because especially now that people are working from home a lot more, our amenity spaces, we've gone through them and reconfigured a lot of them to create more workspaces, and all the kind of stuff that we all know they need right now. I think that's the big difference.
Right, absolutely. And Martin, just curious, you think it's better to be a lender or an owner today? What was the best seat for you to be in the New York market?
I don't know. It's tough. I mean, I think, the comments were made earlier. If you're able to get Sebastian is, I'm not, I haven't figured that out yet. He's got some secret sauce over there. Like if you're able to get a 15, 12, 10, 13, 14, 15% in a return on your money, and you're in a de-risked position compared to where I am, I think it's interesting. Look, the couple of equity deals that we have purchased recently are well north of that, but it's also based off of a lot of work and a lot of assumptions and a lot of growth and a lot of hope, and which I firmly believe in, otherwise would make those bets. But I do think now is a great time to buy. And I think that, I personally think there's going to be some significant outsized returns on the equity stuff that you buy in today's market. I just think you're buying at a low basis compared to what I've seen I've been able to buy real estate at this basis in 15 years.
Wow. And how long do you think that window of opportunity might last for, Martin, without a crystal ball? What's your general take on about, how long we might see this opportunity?
I don't think it lasts more than another 12 months. I think we have a change in guard in terms of mayor right now, and arguably something will happen at the government level with the governor. I think when that settles itself and some of the open questions around some of the regulation that's out there that's still sort of hovering over New York, I think when that's settled, whichever way it settles, it could be good, bad, medium, in between, wherever it settles, I think at that moment, that's where a lot of institutional capital is going to come back into New York specifically, California specifically, and you're going to see those same sort of lower cost of capital that's buying 3 caps in Milwaukee coming back to New York. But I think that needs to resolve itself.
Right. Interesting. And Sebastian and Martin, you're both construction lenders. So how do you find just now the competition in the market for the construction of multifamily product? You did a deal in New Jersey, right, Martin, recently? Is that correct?
Yeah, we've been doing a lot of lending in New Jersey, in Westchester. Obviously, we've been doing a ton in Brooklyn, Queens, Bronx, and stuff like that. I could tell you it's gotten super competitive in the world that I live in.
That's what we hear. How about you, Sebastian?
Same. Yeah, it's much more challenging in the New York area than it is outside of New York. I think there's just always a lot of capital that's chasing New York transactions. So to get one here is rare. But a lot more. The country's very big. There's a lot of other cities in New York City that we find where we're paid more appropriately for the risk.
Right, absolutely. Actually, one of the questions from one of our audience viewers is, how do you think about risk adjusting your returns in the credit space, given the volatility of the New York City multi-market?
I'm happy to take that one. So for our end, it's kind of simple. We have our target returns, and we try to make sure that we can hit those target returns within a specific deal. So we're not like a bank where we're trying to price it perfectly, and we have some model that kind of works out to where you can charge this rate. There's no like black box where you could type in a couple numbers and get a rate of return. Right. So we try to compete for the highest rate, and with the least amount of risk. And being in the credit space, even if we're off by 10%, even 15% on our underwriting, we're still pretty safe just because we're building cushion to all these transactions. So that's kind of the beauty of being in the credit space, where it's on the equity. If you're off by 10%, it's a bad day.
Right. Absolutely. Now, before we switch to markets, we've got 10 minutes left here, and this is going really quickly, but as always does. John, what are you seeing in terms of competition in the lending space, and how is that competition kind of getting, I guess, ebbed or flowed over the past couple of years?
Yeah, I mean, it's been high and it remains high. Competition is keeping spreads down by and large, and down to sort of generational lows. So, on the mortgage market, it used to be an average of 200 over in spreads, and now we're probably in the 150s, certainly for affordable properties, depending upon the leverage. So that's always, I think that's good news for borrowers. So to answer your earlier question, I think it's better to be in the equity side than the debt side at this point.
Right.
I'm exceptionally bullish on the overall prospect for the multifamily market nationwide, certainly New York City. Single family homes are being, everybody's being priced out. And so I think you're going to see the renter demographic. People are going to stay in multifamily longer than they anticipate, because they're not going to be able to buy that suburban home when they hit age 35 and have a couple kids and need space to move out. But debt markets, I think, are as competitive as they've always been. There's been some consolidation in the Freddie Mac, Fannie Mae, HUD lending area, and that's going to make it that much more competitive, in my opinion. So.
Sure. I feel like there was such a tiny lenders market window, early in the pandemic, and then that quickly turned back to a borrower's market.
Yeah,
right?
and it's typical lenders. We pulled back and we didn't take opportunity. We didn't take advantage of that opportunity.
You're not alone.
Yeah.
Mir, go ahead.
And the one thing that's encouraging to me is, in the past, whenever there was competition among lenders, it was always how much money you're willing to give me.
Yeah.
So, in the last cycle, it was, I'll give you 90%, well, I'll give you 92%, I'll give you 95%, until you ended up at 103. It seems like the competition now is mostly about the rate. Everyone's pretty much holding firm to underwriting at 80% max or 85% max if you're getting a bigger return. But you're not really seeing those crazy loans that you did the last time there was a lot of competition in the market, which is encouraging.
100% agree. I do think the competition is absolutely on price. Credit standards have been reasonable and stayed steady over the last couple years, and so I think that's good news. But listen, if you price a deal wrong, you could still lose money. I think people forget about that. But to your point, you're spot on. The competition has been on price, not on proceeds.
Right. I did see recently one, firm who I wouldn't name, put out this flyer for no doc loans, which is something I haven't seen for a while. Low doc, no doc, so no documents required for financing, which seemed a little bit of worrying given what we saw in the GFC. But it's certainly something I haven't seen for a long time. But it definitely caught my attention as something that could be potentially worrying. But I agree, it's very different kettle of fish compared with the GFC and what we saw then. Now, in terms of we mentioned earlier the Sunbelt market, so. John, do you want to talk about that? Obviously, there's been a ton of interest in the southern, the Sun Belt, but
yeah, clearly, again, there's been a lot of capital moving to the Sun Belt, just because, again, rental growth has been so amazing. I mean, year over year, rental increases have been north of 20%, sometimes 25, 27% on average in some of these Class A Sun Belt markets. Atlanta and Dallas and Austin, super hot. So I think, will it continue, right? So you're seeing some ridiculously low cap rates that are getting, people are paying to get into those markets. And this is where, again, I think smart equity is going back to some of the lower beta offices, markets like New York City, which provide, I think, still a reasonable return. So yeah, the Sunbelt markets are exceptionally hot. There's increased supply that's coming into those markets. And so that I don't think those 20% plus revenue, is going to continue. Certainly, that's pretty obvious.
Yeah, competition everywhere. Now, Martin, I think, I could probably read your mind in terms of, I think New York could be your market of choice, right? But For everybody else in the panel, what's your favorite markets here? What do you find the most interesting? I know, Sebastian, you did a deal in Nashville earlier this year, but any markets you think are either, attractive from a yield perspective or just a general, this is where I want to be perspective?
I mean, we're very bullish Nashville. I think the amount of job growth that is coming there is actually pretty insane. I mean, between Oracle and Amazon and AllianceBernstein, there's like 15,000 new jobs, all making, pretty healthy six-figure salaries. And It's not that big of a city. It should have a very dramatic impact to the rental population there. Atlanta's another one of those where we just see strong corporate relocations and migration, and that's majority of the barometers that we try to follow is where the jobs are going, where the people are going. And I mean, no, nothing new that people are doing it across the board, but I mean, we strongly believe in that kind of strategy.
Interesting. Martin, was there
Charlotte in there as well, and Austin I mentioned before.
Austin, we heard a lot about Austin.
Yeah.
Martin, New York.
Yeah, I mean, I don't. Yeah, I'll be honest. I don't have as much experience with it, but everything that's being said. I mean, everything I read about, it's the same 15 markets that everyone's sort of really chasing after. And what's surprising to me is the year-over-year growth in rents. You're quoting number 20%. Those are monster numbers, and I've seen some of the underwriting on the debt side of some of these B+ multifamily suburban deals, and they're still underwriting 8% growth for the next 5 years per year. Yeah. So it seems a little bit aggressive to me, but I got to be honest, I'm not really in the markets. I would love to take some models and throw 8% growth a year in them. They would look great. I haven't been able to.
Mayor, any feedback from your clients in terms of markets that they're pursuing right now?
We are seeing a lot of Nashville, Memphis. A lot of people are staying away from Florida just because they think it's been overpriced already. So whoever doesn't already own land there is very challenging to make a deal work. One of the things we are seeing, I mean, I've been going to Nashville now for 4 or 5 years just recreationally, and the city's booming. But there are some cities that have severe infrastructure limitations. I think Florida is starting to deal with that. Nashville's, the traffic there is impossible at this point because they don't have a subway system. I was down in Miami last week. I was down in Miami, and they were talking about train systems and tunnels and stuff just because they can't handle the infrastructure. I think coming out of New York, we're spoiled where I forget who it was. It was one of the big developers in New York who said he won't buy a building that's not within 5 minutes walk from the train because that's what people used to get from suburbia into Manhattan. We take it for granted, but when you go to a lot of these other cities, they're up against the wall because it's very hard to build a train station from scratch or a train system from scratch. Yeah. So, there is a crossover point where it's going to be just too much for them to handle. Nashville's probably almost there already.
Right. As much as we complain about the New York subway, it's not half bad when you compare it with other markets. It's not bad, right? It's better than nothing.
Yeah.
Now, we've got a couple of minutes left here. So I'm curious to see, obviously, I think everybody's having a really busy quarter, but curious to hear from each of you, first of all, how's this quarter going and any, projections for next year in terms of activity, what we might see from your firms? Martin, do you want to kick us off?
Sure. It's been a very busy quarter on the debt side for us. We've probably closed north of $500 million of loans in the last 60 to 90 days, just because we had a big pipeline that we just ended up closing on. So it's been a pretty good quarter on the debt side. On the transitional housing and workforce housing side, we've also been extremely active on the equity side. We've probably purchased 5 or 6 different assets, and they range from existing to sites that we are going to be developing ground up or existing buildings being converted into transitional housing. And on the equity side, a little bit slower, although I will tell you that our pipeline looking forward is as deep as I've seen it in the last couple of years. So hopefully if things go the right way, we'll have a good beginning of next year.
Excellent. John, how about you?
I think we're going to have a good year. CPC operates on a fiscal year that ends in June of next year, but we're trending towards, over $1 billion in activity, roughly half in traditional construction loans, affordable construction loans, and the other, $500 million GSE and agency HUD loans with a little bit of equity involved. So good year-over-year growth, probably in the order of around 10%.
Nice. Great. Sebastian, how about you?
I think it's probably the busiest quarter we've had to date. We've done more deals in the last quarter than we've done all year. And I think if I ask a team member to look at another deal by year-end closing, they probably would quit the next day. Our biggest challenge in terms of getting deals done now is just getting appraisals. We're hearing from some of these markets that you can't get an appraisal until January and February, which is kind of crazy to me.
That's crazy. Wow.
I guess supply chain issues affect appraisers as well. So,
wow, that's something
I hear a new business line opening up for you.
Exactly.
We actually do. Yeah. We actually are having problems doing appraisals too because we're backlogged, but we don't do the actual dirt appraisals. We do the partnership interests for gifting and stuff. And, we've been seeing a lot of that stuff, Sebastian, on the appraisals, not just on the deal side, but because a lot of people were nervous about estate planning changes. They're trying to gift stuff, and they've been a little ahead of the game because everyone thought that was changing in June. So they lined up a lot of these appraisers to start working in June, July, August. And, that's part of the backlog too, just because of the tax policy. And we've been seeing also a lot of sales with year-end closing because of the tax policy. Everyone was concerned rates were going up. So we've been seeing more activity that needs to close by year-end this year, some pretty large transactions that are in the pipeline. Just because of people were concerned like-kind exchanges were possibly going to go away. I think there was about 10 minutes that it was in one of the bills. So tax policy is motivating people to do stuff before year end. I'm hoping that it will continue because sometimes once you see activity, it does kind of pick up a little more. So we have been seeing an uptick too.
Right. And we're out of time here, but just one really quick question. Any very kind of glaring headwinds that will, put a stop to this kind of impetus behind the multifamily market? Anything that you think is going to end this, cycle of it being the most kind of coveted asset class out there?
And rising costs are the only thing that scares me.
Yeah.
Right.
If the costs go up because of the supply chain, because we can't get it from abroad, you're not going to be able to raise your rents 10% because the cost of energy went up 20%. So that's something we are seeing people be concerned about.
Interesting.
Yeah, share the same sentiment on the new development side. It's all about costs, and God knows where they're going to go in the next 6 to 12 months. That's probably what is our biggest worry.
Right.
Rising costs on the development side obviously helps the health of the existing inventory of multifamily, but a new variant of COVID, that certainly could throw us for a loop. So
God forbid. Yeah, hopefully.
Yeah, God forbid.
Yeah. Martin, any final thoughts?
No, I mean, I share everyone's opinion. I mean, it's to be determined.
Yeah. Well, on that note, I want to thank you all so much for joining us today, and thank you to all our panelists. It's a great discussion. It's so great to have this chat with you today. I'm sure if anybody has any questions for the panelists that are outstanding, just send an email or something like that. But this is a great discussion. Thank you all so much for your time today.
Thank you very much, everyone.
Take care.
Thank you.
Mom had such a great vision for the company. I don't know that I can keep it going.
Amy, your mother worked with Burden to develop a plan. Don't worry.
Life and business can be hard, but finding the right advisor to help you, your family, and your business get where you want them to go doesn't have to be.
Stephen, get Burden on the line.
Burden LLP. We listen. We solve. We do.